Hello and welcome to IlaNomics, or actually IlaNomics Plus as we are calling it today. That is because we not only have Professor Ira Patnaik on the show as we do every week, but also we have another of India's top economists with us today, and that is Sajjid Chinoy, JP Morgan's chief India economist. This will be a new feature where we will regularly have another expert join us on the show while we also bring you our weekly IlaNomics with Ila separately, which is why we are calling it IlaNomics Plus. Sajid, for those who track macroeconomics and markets in India, does not need any introducing. But let me just say that among the many achievements on his bio are that he was on the advisory council to the 15th Finance Commission. He has worked at the IMF and McKinsey and Company, served on RBI panels, and has been ranked as one of the best individuals in research in India. At present, he also serves as a part-time member of the Prime Minister's Economic Advisory Council. Hi, Sajid. Welcome to IlaNomics. It is such a pleasure to have you with us on the show, and thank you for agreeing to spare your time.
Thank you, YP. Thank you, Ila. Real pleasure to be on the show.
Today, we are focusing on only the one thing that there is to focus, and that is the impact of the Ukraine war on the Indian economy. Specifically, the fiscal and monetary policy outlook for India in the current scenario. Sajid, firstly, I'll come to you. I mean, what a week it has been, and how one week has turned so many things, if not everything, topsy-turvy for the global economy and the Indian economy, of course. We were, just before we started recording this show, you mentioned oil touching 115 today. In the morning, it was 118. And that has very, very serious implications. So before we go to the larger fiscal and monetary policy issues, do you want to talk about those implications, Sajid?
Thank you, YP. As you pointed out, it seems like policymakers around the world can't catch a break. 2020 was the year of the largest contraction the world has seen since the Second World War. Just when we were coming out of that, 2021 was the year of very sticky inflation. Just when markets were kind of internalizing the fact that the Fed will be raising rates aggressively in 2022, here we are with a big geopolitical event. YP, I think it's important to kind of distinguish the wheat from the chaff because there are many channels of transmission to India. One is the direct trade impact to the affected region. The second is the indirect impact from the global economy and Europe slowing. There is an impact from tighter financial conditions and capital flows. But I would argue those are relatively second order in magnitude. What we should focus on for India, the primary channel, I think, will be a negative terms of trade shock from higher commodity prices. And primary among them is oil because we import almost 85% of our oil requirements. So the worry is oil has surged past $110. And now there are many global forecasts which peg average oil prices at about $100 a barrel for this year, for 2022. Right? The more entrenched this war gets, the greater the expectation that oil prices will remain elevated for many months to come. So the way to think about this is average oil prices for India last year about $70 a barrel. If in fact at $100 a barrel, that is what we economists call kind of a negative terms of trade shock. Essentially what that means is there's about 1.2% of GDP that we will pay more as part of our import bill to import the same net oil imports because we also export some refined products. So once you net it out, the cost to the economy is about 1.2% of GDP. Now that will have a growth cost depending on who bears that cost. Is it the fiscal? Is it households through lower purchasing power? Is it firms through compressed margins? So depending on who bears this cost, there will be a growth cost. Important to remember that the government raised excise duties quite sharply when the pandemic started. Some of those got reversed last November, both petrol and diesel. So essentially of this 1.2% of GDP cost, 0.4%, a third, has already been borne by the fiscal through those excise duty cuts in November. The question is, where does the remaining 0.8% get borne? Will the government cut more duties or will it pass some of this on? Our sense is depending on the distribution, this is about a 90 to 110 basis point. So, zero point 0.9 percentage points to 1.1 percentage points hits to growth from this negative terms of trade shock just from oil, which is not trivial. And this doesn't include, in fact, gas prices going up and coal prices going up. So bottom line is we should focus very intently on how elevated and sticky will commodity prices be, and therefore what the growth impact in India is expected to be.
If I may follow up with a question, Sajjid, do you expect that these oil prices would remain elevated for a long time, or could it be that either the OPEC could, decide to change its supply, or that other countries that have reserves could use some of those reserves, and that the global community could in some way not that there is a single global community,
right,
but many countries, oil importing countries, or those who are going to be impacted negatively, could come together and try to get this price down, and that it doesn't remain elevated at these levels throughout the year. What do you think?
That's a great question. I think there will be some element of that. The only elephant in the room here is that Russia is such a big oil producer that at least our commodity analysts around the world believe this will be a very big gap to fill. Now, the global community has tried to mitigate the impact by giving carve-outs for energy, for gas and for oil from Russia. But as we're seeing, the carve-outs become less effective when the financial system begins to get segmented. So we're finding that those carve-outs are less efficacious if banks around the world don't want to do business with Russian banks, for example. And now we're also finding out in the last 24 hours that some countries don't want to, for example, buy from Russia. So my point is there will be some mitigating impact, which is why people feel that oil prices will be in the $100 to $110 range in the near term. If Russia were completely taken out of the market and we could not make those supplies up, then there are crazy expectations like oil being at $150. So the expectation of an average 100 presumes that there is some offsetting supply that hits the market if Russian to compensate for lower Russian supplies.
Sajjid, if I may, take us back to a time when oil prices had touched 140, not in the very distant past. What are the lessons we learned from that time, Sajjid?
I think the couple of near-term and medium-term trade-offs here. The near-term trade-off is, well, we want consumers to essentially see some of the final price, because behavior will adjust. So when retail prices move up, people will adjust their behavior and consume less, and import volumes will come down. There's also this whole issue of a green economy, and you want to put on taxes on for example, oil. But we also realize that whether the fiscal cuts these duties or not actually has an impact on growth, because the marginal propensity to consume is different. See, so every time the fiscal cuts oil duties, the opportunity cost here is lost spending. So it's almost a 1-for-1. And if you assume a fiscal multiplier of 1, it means if 0.5% of GDP is lost on the revenue side because oil duties are cut, that's a 0.5% of GDP that's potentially lost on the expenditure side, and that could have targeted the bottom of the pyramid. In contrast, if some of this is passed on to households and to firms, their propensity to consume is typically less than 1. It's closer to 0.7. So the trade-off is the following. The more the fiscal bears, the bigger the hit to demand and the bigger the hit to growth, actually. That said, to the extent that this is passed on to consumers, the hit to demand could be less, but because of inflation expectations being so sticky, if retail prices were to move up even further, it could further harden inflation expectations, and that makes monetary policy's job that much more challenging. So there's a very clear trade-off here that we have to recognize. There are costs and benefits both from cutting duties and not cutting duties. I think that's the near-term lesson. The one quick point I'll make about the medium term is, I've been arguing for many years, we really should start a program of trying to hedge these oil costs, right? So Mexico, I know, on the other side, hedges oil exports. India is a very large oil importer. Let's try and protect ourselves from the vagaries of sharp oil movements by by putting in place an institutionalized framework to slowly, progressively hedge these oil prices in global financial markets. So we're not in a position like we are today, where within a month oil has moved from 80 to 100, almost 120.
Yeah, so very interesting, Sajjid. What you're saying is that it is not obvious, as a lot of people argue, that cutting excise duty to reduce prices of oil in this current situation is a good idea, because that's going to hit growth and that's going to hit investment and jobs. And people who, very often come up with this, oh, look, there's so much excise that the government has imposed on fuel, and now that prices are up and it's only pushing prices up and the government should absorb a part of it, is not necessarily something that is going to be good for the economy, because it's going to lead to a reduction in demand, thanks to the differences in how much of a rupee in the pocket of the consumer gets spent versus how much of the rupee in the pocket of the government gets spent, and that the government spends the full rupee whereas the consumer spends 0.7, and that because of that fact you might actually slow growth down. I guess most people are thinking of it from the point of view of inflation and how it hurts pockets. Sudden increase in the price of oil, when your fuel costs go up suddenly. There's so much.
Yes.
It's not even happened slowly. It hasn't given us time to adjust. And in the short run, elasticities, price elasticity of demand for oil is actually very low. I mean, you just end up spending more because you can't move away from it. So yes, it's a very difficult and very tricky situation for a government to be in, particularly, I guess, just barely about 2 years before an election.
And I would simply say, I think, therefore, there are probably no corner solutions here, because there are costs on both sides. That maybe there has to be some kind of equitable burden sharing, where the government takes some of this on to protect consumers from the full increase. Precisely because inflation expectations have hardened over the last 18 months. We don't want them to harden further. And we know consumption is taking a long time to recover after the pandemic. At the same time, as you said, if the government should not take all of it, because then we don't want to cannibalize much needed expenditures that are specially focused at the bottom of the pyramid.
I think in addition to your assessment of what it means for growth, it would also be interesting to talk about your assessment in terms of inflation. That in a scenario, let's say in a scenario where excise duties are left unchanged, what is the kind of inflation that you would expect? So I suppose you would have to look at the direct inflation, which is, just the fact that fuel prices have gone up, the indirect effect, the fact that you have transport and other costs that will go up, and perhaps also that fertilizer subsidy will go up. And so the government will borrow more, and there will be maybe a demand effect there as well. I don't know, what else would you look at, and what are your kind of inflation projections?
No, that's exactly right. There are many channels of transmission here. What we're doing as a starting point is looking at the RBI's estimates of this, because presumably their modeling has incorporated both the direct effect and the indirect effect. And what the RBI's sensitivities tell us is, for every 10% in increase, oil prices increasing, it pushes up inflation, headline CPI, by about 30 basis points up. So now effectively what we have to recognize is the retail prices were already kind of marked to market at $80 a barrel. So really we're talking about, if oil were to average $100 a year, it's the next $20 that we have to calibrate in terms of growth, inflation, the current account. And that would mean, if you just take the RBI's estimates at face value, this is about 75 basis points or thereabouts. It's a 25% increase, which would be about 75 basis points. Now, these are average estimates.
Of course.
A lot will depend, as you said, growth is going to slow. So how much pricing power will firms have to pass all of this, the indirect effects, on to consumers? So I would say 75 is very much a ballpark figure. Somewhere between 50 and 75, depending on where we are on the growth cycle, perhaps seems appropriate. But I think the issue is, coming into this episode, inflation has been very sticky. Right? Core inflation has been running at 5.5%. And the expectation was in 2022 that services prices may go up because the pandemic is fading. People will be switching expenditures from goods to services, retail, recreation, travel, health, education. Now, the services economy has taken quite a beating in the last 2 years.
Right.
And small businesses in the services economy may use relatively inelastic demand in the near term. If people haven't gone to a restaurant for 2 years, they'll be less price sensitive for the next 6-9 months to actually, increase prices and make up for some of the lost income in the last 2 years. And we're seeing this phenomenon around the world. That as the services economy opens up, services inflation goes up. Now, the hope was that simultaneously you will get goods disinflation, because this was going to be the year where supply chains normalized, right? And goods prices would come down. And I think that's what the RBI was banking on, that you get this rotation in inflation. The worry now is you may well get the services inflation, but because energy costs are higher, and we haven't spoken about the fact that supply chains could further be disrupted by what's happening in Russia, that you may get more cost push pressures for firms who may at some point be forced to pass it on. So there are going to be all sorts of tricky trade-offs, both for fiscal policy and monetary policy, because what you get on the one hand is weaker growth, but you're getting stronger inflation. So I think the worry is we're coming to this with underlying inflation at about 5.5, and then you get another hit here from oil.
And I guess we already had a situation where there was fiscal dominance, so the RBI was trying to accommodate the government's larger borrowing program by keeping interest rates low. Now, the government's borrowing may actually increase, while at the same time, inflation will go up. So then what does RBI do? It's going to be very tricky.
It's going to be very tricky. So, and we haven't even spoken about the rupee, because I think the other element to this is if oil were to average close to 100, then the current account deficit for this year could be close to 3% of GDP. Now, to put this in context, the current account for the 6 years before the pandemic was as low as 1.1% of GDP. So we had got used to living with low current accounts. There were strong capital flows, large balance of payments surpluses. The policymakers had a problem of plenty. Now that's changing because of commodity prices. So October to December, the quarter that just passed, our estimate is that the current account was already 3% of GDP, and it could remain close to those elevated levels. So what you might find is now, if the current account is widening because of oil and coal, for example, and capital flows to emerging markets are slowing because the Fed is still raising rates, global financial conditions are tightening, then for the first time in many years, the BOP could be under some pressure. Now, I want to emphasize there's absolutely no macro stability risk here, because the RBI is sitting on a war chest of reserves. If you add their spot reserves and what they have in the forward book, it's almost $680 billion. So there's plenty of ammunition to support the BOP. But the point is, the new equilibrium, Ila, that you alluded to from a terms of trade shock will perhaps have to be a slightly weaker rupee, higher rates, and a judicious fiscal mix. The one policy prescription that I think all of us will agree on is that when you're hit by a negative terms of trade shock, you will typically experience a real depreciation of your currency. And that, in fact, is the optimal response. You want to let your currency adjust, because that will necessitate the expenditure switching that's required. So the equilibrium real effective exchange rate with higher oil should be weaker. We should gradually let the currency move to that new equilibrium, because then you will essentially make imports more expensive, you will give a boost to exports, and you will try and narrow that more elevated current account deficit. So this is going to be all will need very deft macro management, where the rupee is slightly weaker, rates may have to gradually move up, and the fiscal will have to balance this quite judiciously.
So perhaps you don't actually want to use that war chest of reserves, because when you have more expensive imports, you want to let it's a dilemma, of course, because imports in rupee terms will be more expensive with a depreciated rupee, with a weaker rupee. But then with this terms of trade shock, you also want to push up your exports.
Yes.
So if you were to start using the war chest and keep the rupee strong, if I may, or where it is today, then you are not allowing that adjustment to take place. So currency policy is going to be a very difficult tightrope walk on what to do.
Correct.
Even
and I think perhaps we can agree that we certainly don't want to interfere with the adjustment. Perhaps one only uses reserves to ensure that the pace to the new equilibrium is gradual and calibrated and doesn't, get expectations in the FX market unhinged. But you're exactly right that we want to enable that adjustment because that it becomes that shock absorber for the economy when you're hit by a negative terms of trade shock.
And Ila and Sajjid, if I may just add to that point there on the rupee, the rupee has fallen 1.5% already in the last 7 days since this whole crisis began. Today, just before we started recording this, it was at 75.88. Do either of you see it falling further and how much further?
I think RBI has been intervening. Mm-hmm. So RBI has been, I think so. We'll see the numbers in the next weekly report. But I think the RBI has been intervening. And actually at this time, Sajjid, if the RBI was to intervene and then sterilize, the government will also be happy because it will buy government bonds, and after the budget, there were concerns about who's going to buy these government bonds. Banks thought, will they be dumped on us? Foreigners were not willing to buy them. And now if the RBI actually steps in to sterilize its intervention, it may make everyone happy. I don't know. What do you think is happening?
Well, a good point. Yeah. Well, first thing, just to respond to you, YP, I think it's really important that if the dollar were to strengthen in a risk-off world, all emerging market currencies will weaken to different degrees. So I think it'll be important when we're judging our competitiveness to look at the trade-weighted real effective exchange rate. That's the kind of real depreciation we want. If we're just moving as much as everybody else, we're all effectively on a trade-weighted basis at the same level. Ila, you're right. At some level, if bond yields do get unhinged, as global financial conditions tighten or the rupee is under a lot of pressure, then you essentially, this is a substitution on the RBI's balance sheet because they're going to reduce NFA, net foreign assets, and increase NDA. Yeah. Having said that, I think tactically that's fine. But we're sitting with a large overhang of interbank liquidity. I think it's close to 10 trillion rupees. And when you have so much liquidity, it becomes hard to establish monetary control at the short end. Right, so the call rate has been bouncing around, and I think so. Yes, at some level, you don't want yields to unduly harden and tighten financial conditions. But if it turns out that the balance of payments deficit is providing a chance to gradually wean some of that rupee liquidity, because you're selling dollars, absorbing the rupee liquidity, and not sterilizing it, that may not be a bad thing. If inflation is going to be sticky, it will allow the RBI to gradually normalize liquidity. In fact, this would be the reverse process because a lot of this liquidity got created in the pandemic year where we had a current account surplus, huge capital inflows, I think a balance of payments surplus of 80 billion. And I think the RBI did the right thing by intervening aggressively to prevent rupee appreciation. Yeah, that created all this rupee liquidity. So if you're getting a chance to soak some of that in, that may not be a bad thing, to establish more monetary control in the coming quarters and years.
What impact do you think it will have on interest rates and call money and government?
So I think a couple of things here. One is that markets expect at some point the policy corridor to be normalized. So you have a situation now with the repo rates at 4%, the reverse repo is at 335. But the effective reverse repo rate, the average is closer to 4. So markets have already moved ahead. But I still think it's important at some point for the RBI to narrow that corridor, because what happens is when there are mismatches in liquidity, the overnight call rate bounces between the bottom of the corridor to the top of the corridor and sometimes beyond. And that kind of volatility just creates more risk premium at the short end. So if for no other reason, we want to first narrow that corridor down from 375 to 4, so that when liquidity were to bounce around, the call money rate isn't bouncing around by 50, 80, 100 basis points some days. Now, after that, the RBI has, it's a trade-off because inflation is going to be sticky. and be pressured. But at the same time, growth's getting another hit from the terms of so adverse supply shocks are very hard to confront because you have both things happening at the same time: lower growth and higher inflation.
So why do you think they did not change the reverse repo, say in the last policy, or they had, they even though the call rate has moved up, but the reverse repo was not raised?
Yes. I think a lot of the policy actions are perhaps predicated by where they see inflation. So I think if you looked at both the RBI's growth forecast and their inflation forecast, at least before the oil shock happened, the RBI was a little bit more comfortable believing that inflation is going to go down. I think in part because their growth forecast will suggest that the output gap is still meaningful. So if you take that growth forecast, you will still be in a situation where at the end of this year, India, compared to its pre-pandemic path, is 6 or 7% below it. In other words, there's a fair amount of slack in the economy. So I think the RBI coming into this perhaps believed this is the year where supply chains normalize. You should get some goods disinflation. There's still going to be a meaningful output gap, which means firms may not have pricing power. And the hope was food prices are well behaved and we hopefully have a normal monsoon. But you need for all of that to happen to get inflation to go below 5%. Now, all those assumptions will be challenged because if energy prices go up, cost push pressures are higher, supply chains may not normalize. So we have to perhaps revisit those assumptions.
At such a juncture, Sajjid, do you think we could assess our growth estimates and projections? We already saw Q3 growth being much lower than expected, and the annual growth numbers were brought down from 9.2 to 8.9. Do you think even 8.9 is achievable now in this scenario? And going forward next fiscal, what happens?
Yeah, I mean, there's so much uncertainty that it's hard to predict 3 or 4 quarters out. I'll just make 2 points. One is when we're assessing how we've emerged from the pandemic, sometimes looking at year-on-year growth rates are a bit deceptive. I think we should perhaps focus on levels. Okay. And the discussion should be, well, absent a pandemic, what was our pre-pandemic path of GDP? And by the end of 2023, where will we be in terms of the level of GDP? How close to that pre-pandemic path will we be? We'll probably end this year closer to about 7% below the pre-pandemic path. And so really the goal for India has to be in the next couple of years, how do you shrink that gap? How do we get progressively closer to the pre-pandemic path? Now, to be fair, only the US is back on the path, and all emerging markets are below the path to different degrees. But the longer we remain below the path, the more permanent is the income loss from the pandemic. Now, the second question is, where is growth going to come from? And I've been making the point for the last year that we need to be patient. It's unlikely that private consumption and private investment are going to fire anytime soon. So if you think of GDP and think of the components of demand, it's C plus I plus G plus X. I think until the employment scenario improves, expecting private consumption to fire, may not happen anytime soon. And we've seen that in the last few GDP prints. Private consumption is still sluggish. The good news is on private investment. There's been significant deleveraging there. Corporate debt to GDP is down to its 2003-4 levels. So the balance sheet problem that used to constrain us it has been alleviated. The issue now is demand. It's not a balance sheet issue. That utilization rates for manufacturing are still in the mid-60s. So even though corporates are ready and willing to invest, they need to have more visibility on demand and utilization. So we need to be patient both for C and I to recover. Therefore, the heavy lifting in the near term has to be done by G and X. Now, X provided strong growth for much of 2021. But with all of the global uncertainty, that Russia-Ukraine has created, we shouldn't bank on X anytime soon, which puts a lot of premium then on G. And therefore, my mantra has been, I think the government's doing the right thing by a big push on infrastructure. I think public investment will have to lead growth in the next year or two. And hopefully, a lot of infrastructure projects create construction jobs at the bottom of the pyramid. And that job creation hopefully will spur some consumption. If there's a lot of public investment, hopefully we can crowd in private investment. So A, we need to be patient. B, we need to be clear where the growth is going to come from. And in my view, it'll have to start at least with a big public investment push. So I'm very gratified that that is the focus of the government. But it's important that, center, states, PSUs, this needs to be a full court press, which then brings us back to our original question, that if fiscal space is constrained, we want to be sure that we're not cannibalizing resources for public investment, health, education, physical infrastructure, because those fiscal multipliers tend to actually be very large.
Typically, Sajid, whenever there is pressure on the fisc, so an oil price hike, subsidy hike, or an excise duty cut, typically whenever there is pressure on the fisc, then we do see that capex is what suffers. You can always slow it down. You can internally in the government, whether they do it by design or whether they do it, it's automatically what happens. But capex is what goes down, and capex is what suffers. And so, if we have a budget where I completely agree with you that this was the right stance, and that the right strategy was pushing capex. And yet I worry that the negative shock to the fisc, thanks to the oil price shock, would actually mean that it is exactly capex which suffers.
Yeah.
And so, I would have been more optimistic about G prior to this shock than now.
Ila, you make an excellent point. Just a couple of mitigating factors here. What this budget did, like last budget, was actually be very conservative in tax revenues. So if you take gross tax revenues that are budgeted on the base that we expect will turn out this year, and you take excise duties out, we did the math that even if the government were to take the entire excise duty cut that's remaining, it will only probably take a buoyancy of 1 on non-excise duties to meet your budget targets for next year. Now, I don't want to trivialize the point, because growth might be hit and there's a lot of uncertainty. Corporate margins may come under pressure. So I'm just saying that there is a little bit of a buffer still built into the fiscal, or was built into the fiscal. And so if there's a little bit of hit that the fiscal takes, it hopefully will not cannibalize at least budgeted expenditures. Of course, there's an opportunity cost here, because absent this oil shock, if your revenue surprised to the upside, you would have had more resources to invest in capex. Right. But at least you will deliver what's budgeted, because there was some buffer built into the revenue side, which can be used for the oil for oil taxes. Second quick point I'll make is all the more reason we need to double down on asset sales and disinvestment. I think that's an obvious solution, that to increase fiscal headroom, we need to continue with this disinvestment plan. I can understand that markets are very volatile now, but as soon as markets stabilize, it will be good to continue with this process. Let's not try and time markets perfectly, because that's virtually impossible to do. Let's just have an institutionalized, systematic disinvestment program, because those are the resources that you can then use for higher capex or fiscal consolidation.
That is the news. So we are hearing on the big IPO that is in the being talked about, which is the LIC IPO, and tomorrow there will be a decision on whether to do it in this fiscal or push it to next fiscal. Hopefully, it's sooner rather than later. Sajjid, my last question, and both of you can pitch in. It was almost as if the budget was prescient in its focus on capex and infrastructure. Like you said, we are on the right track. Is there any room for course correction anywhere else, both on the fiscal side and the monetary side, Sajjid, given what has happened since the budget?
Yes, no, we'll have to be very nimble here. So I think the good news was there was these revenue buffers that were built in, and so it allows for some flexibility, but we'll have to be equally flexible on the expenditure side. For example, last year we saw that demand for NREGA went up. So if there's a growth shock, and that means demand for NREGA goes up, or you need, God forbid, to give a little bit more food grains out later in the year, we essentially, have to be nimble. What is the old saying? Cross the river by feeding the stones, right? Both on the revenue side and the expenditure side. The one non-controversial part in my mind is to increase the fiscal envelope by doing the disinvestment of the asset sales. Mm-hmm. Everything else, there will be trade-offs. Here, I think the trade-offs are relatively limited. I think on monetary policy, this is going to be challenging, because on the one hand, inflation may get more sticky. On the other hand, growth could be under pressure. And I think, however, the governing principle needs to be that in general, let the currency undertake the adjustment that's needed. And if we have to choose between fiscal and monetary policy, my own preference is in an uneven recovery, fiscal policy is more suited to provide targeted support. And so if I have to choose, I would say let the fiscal provide more targeted support given the constraints it is. Let the rupee become the adjustment mechanism for the external sector. And if the implication of both those policy choices is that monetary policy has to normalize, a little faster, then I think that's a price worth paying.
Ila?
Yeah, so I think it's going to be a difficult year compared to what was expected in the budget. That is, that things would start normalizing, that growth would pick up and inflation would go down. Thanks to the oil shock, we might have exactly the opposite, where growth would go down and inflation would pick up, which means that there will be many more people who may need support. And I completely agree with Sajjid that targeted support by the fisc, whether it is free food grains, whether it is a higher Manrega budget, which is actually demand driven, so it does go up when there is more demand for Manrega. Those are the kind of things that the fisc would need to do. For monetary policy, it's going to be a tightrope walk. Inflation is going to be higher while growth would not have picked up. At the same time, government borrowing may be higher. And so, the government, the RBI is also doing its debt management function. The RBI has typically tried to prevent a sharp depreciation of the rupee. So I guess, one is saying, yes, they might continue with this smoothing out of the pace of depreciation, whereas you would expect a depreciation to happen, and a depreciation would also be good in terms of pushing exports. However, Sajjid, there are many people who are going to say that, hey, but a depreciation is also going to raise fuel prices even more. And so you'll, have all these lobbies asking for excise duty cuts, asking for preventing a rupee depreciation. And I think policymakers have to be very clear about what they want. Monetary and fiscal policy should be coordinated, the RBI and the government. So normally we say they should be independent, but I think, I'm the first one to typically say that it should be independent. But I think even in that space of being independent, there needs to be discussion and debate. And, you don't have to do what the government says, but, that discussion and debate should be out there so that the macro stabilization policy is coordinated, and we can see a year that is not as bad as it could be if one was to really mess up macro stabilization policies.
I'll just end with one sentence to say, 50 years ago, James Mead had this great insight where countries should focus on both achieving internal balance and external balance simultaneously. And if you have two objectives, you require two instruments. And I think all emerging markets will struggle to simultaneously achieve internal and external balance. I think we need to let the rupee be the adjustment for external balance and use fiscal and monetary policy to achieve internal balance. And that might well be the right division of labor.
Fiscal targeting should be the focus for the government, and the rupee should take care of what happens on the external front. Let us also hope that President Putin stops targeting Ukraine sooner than later, and we can all go back to fixing the economy. This is not the perfect storm the world needs. Thank you so much, Sajjid Chinoy. Thank you, Ila. That was a very wonderful conversation, and hope we can do this again in the coming months. That's a special episode of IlaNomics Plus for you. We will be back next week with regular IlaNomics. Until then, stay safe and keep watching The Print.
Thank you, Ila. Thank you, IP. Pleasure to be on.